Hi guys and gals, welcome back to the channel. Thanks for joining me here today. Today I'd like to talk to you about free cash flow and owner earnings. We're going to talk about how they're calculated and why they're important in value investing and in the valuation methods that we can use, such as the discounted cash flow analysis and Phil Town's 10 cap valuation, as a couple of examples. So first we'll start talking about free cash flow. Free cash flow indicates the amount of cash that is generated each year that is free and clear of all internal or external obligations. In other words, it reflects cash that the company can safely invest or distribute to shareholders in some way. I find one of the best ways to think about free cash flow is if you kind of owned the whole business. If you owned the whole business, then what money could you take out of it that you don't need for the day-to-day running and growing of the company? When Warren Buffett talks about what the intrinsic value of a company is, he talks about cash that is given off by the company between now and Judgment Day. When he says this, he's talking about the free cash, because this is the cash that is available if you owned the whole business yourself. Kind of imagine if you were going to buy someone's life, someone's economic, financial life, for example. Just stay with me here. If you were going to buy their salary, going to buy their debts and their bills and their expenses, if you want the investment to be a good one, and the only reason to outlay cash now is because you think you're going to get more cash back in the future. Well, if after salary minus debt and bills, there is money left over to do what you want with, then this is essentially the free cash flow of that person's economic life or their financial life. That's the free cash flow that they have left over. It's money you've got left over to do what you want with, having everything that's been paid for already paid for. Free cash flow it's so important because it's getting to the heart of what is truly left over at the end of the year. Net income or earnings, it doesn't show you the whole picture, and Wall Street likes to use EBITDA, which Charlie Munger has very rude words to kind of explain or to describe what EBITDA is. Unfortunately, free cash flow, it's not stated on any of the financial statements, but it can be calculated without too much hassle. There are a few methods, but the one I like to use that is quick and simple is using only numbers that you find on the cash flow statement. And every company has to produce a cash flow statement. And basically, you're taking the cash from operations and subtracting capital expenditures, which sometimes appears as purchases of plant, property, and equipment in the investing activities section. So there's three sections to the cash flow statement. At the bottom of the first section is where you'll find the operating cash flow, or it might be described as net cash provided by operating activities or something like that. And then just below that you get into the second section, which is the investing section. And normally at the top of that's where you find the capital expenditures, or it will probably be down as purchases of plant, property and equipment. So that's the capital expenditures that we're after. So this will, if you take the operating cash flow and you minus the capital expenditures, this will give you a good figure for free cash flow. And it's important to look at those numbers over time so that when you're calculating this, you're doing it based on historical figures, and you're not taking any outliers, either a high outlier or a low outlier. So that's kind of that's how you would calculate free cash flow. There is a variant of free cash flow that takes into account capex used for growth. It splits out the capex from growth capex and maintenance capex. And Warren Buffett refers to this as owner earnings. Now, he had a different way of calculating it back in the day. I think even before cash flow statements were even a requirement for companies to submit. But a simple method, and one actually used by Philtown in the 10 cap valuation method, video on that to come, by the way, is you take operating cash flow, just like before, when you're calculating free cash flow. So you take operating cash flow and you minus not the whole of capital expenditure, but just the maintenance part of capital expenditures, or the purchase of the property, plant, property and equipment. So when you do this, this gets to the heart of, if you were an owner of the business and you had an owner's mindset, what money was actually left over if you chose not to grow the business. If you chose not to grow the business, this gets to the heart of what would actually be left over for you. The decision to grow the business is a choice for the CEO, for management. It's a choice, and it does not have to be done. As long as you spend money on maintaining the business, you don't have to grow it. It can stay in a maintained state, not indefinitely, but for an extended period of time. If you wanted to freeze your business in its current state and just take money out of it without affecting the business, then the owner earnings figure would be the one to use. This owner earnings figure is the figure that I think best represents the cash that we get out of an investment. If you think about it, the free cash flow is money left over after accounting for both maintenance and growth. So that really is just cash left over for earnings. But if you have chosen a wonderful business, you're also getting back the cash that is used for the growth, because the cash should come back to you in some form in the future anyway, as growth in free cash flow, and that the business is using to grow the business, so it can generate more cash in the future with that money it's using for growth. So it really should be counted when trying to work out how much cash you get back from business as an owner. Now, trying to work out what part of capital expenditures is maintenance and what is growth, it's a bit of a tricky matter. You can go to a company's 10K and scroll down, do a Control F or a Command F, and look for where they talk about their capital expenditures. They might talk about last year's, they might talk about this year's, and maybe a year in the future. And sometimes, but not always, sometimes they split that out for you. They talk about what they used to maintain the business, and what they used to grow new businesses. For example, they might talk about what they used to maintain a restaurant. Company might talk about what they used to maintain their current store base, and then they might talk about what cash they used to invest in new stores for growth. If in doubt, you can use kind of 50-50, 50% maintenance, 50% growth, but you really should look and research the industry and the business to come up with a better analysis than just 50-50. To be honest, if you can't figure out some sort of realistic percentage as to what should be maintenance or what should be growth, then you should either keep researching until you do, but in the absence of that, just use the free cash flow figure. Just take away the whole of capex from the operating cash flow, and then you're only building in a level of conservatism. Okay. So that's pretty much all I wanted to say about free cash flow and owner earnings. So those figures can be used in different valuation methods. If, for example, in a discounted cash flow, when you're growing that cash out into the future and then discounting it back at your discount rate, I would use the owner earnings, the figure for that. But I will be releasing more videos soon about those different valuation methods. So now with some knowledge about how to calculate free cash flow and how to calculate owner earnings, you can go ahead and use them in those valuation methods. So be sure to subscribe if you want to be notified of those future videos. And if you liked and appreciated today's video, then I would greatly appreciate if you could like below as well. It would greatly help by growing the channel, so I can keep creating some great content for you guys, and to keep helping you with your own knowledge as well as help my own. Please leave a comment below and get in touch if there's any particular things you'd like for me to talk about, or any questions about today's video. But with that said, I'll let you all get back to your day, and let's all go out there and become super investors together. So I'll catch you on the next one. Take care.